In January 2005, Warren Buffett called it a dream deal. Procter Gamble paid $57 billion to buy Gillette, the world's most dominant razor brand, a company Buffett himself had owned for 15 years. It was supposed to create the greatest consumer products company on earth. By 2024, P&G had written off over $9 billion of that purchase. The reason? People stopped shaving. January 28, 2005. Procter & Gamble announces it is acquiring Gillette for $57 billion in stock. At the time, it is the largest consumer products merger in history. Wall Street erupts. Warren Buffett, Gillette's largest shareholder with 96 million shares, goes on record promising to buy even more Procter & Gamble stock. He makes $645 million in a single day. The logic was bulletproof. Procter & Gamble dominated women's personal care, Olay, Tampax, and CoverGirl. Gillette owned men's grooming, razors, Braun shavers, Oral-B toothbrushes, and Duracell batteries. No overlap, pure synergy. Together, they would control $21 billion brands and generate 5 to 7% annual sales growth forever. Gillette was not some struggling brand P&G was rescuing. Founded in 1901, it invented the safety razor and the disposable blade business model. Sell the razor cheap, make a fortune on the blades. By 2005, Gillette controlled over 70% of the global razor market. It sold $6.22 billion in men's razors and blades annually. The Mach 3, launched in 1998, was the most successful razor in history. This was a cash printing machine with unbreakable customer loyalty and pricing power that could justify charging $30 for a 4-pack of cartridges. The deal closed in October 2005. P&G issued nearly 1 billion shares to Gillette stockholders. Buffett eventually traded his P&G shares for Duracell, exited his remaining position by 2023, and walked away. For the next decade, Gillette performed exactly as expected: steady growth, massive margins, market dominance. Then everything changed. 2011, a startup called Dollar Shave Club launched with a viral YouTube ad. The founder, on camera, says, "Our blades are fucking great." The pitch was simple. Gillette charges $30 for cartridges, Dollar Shave Club charges $3 per month and ships razors to your door. Within 5 years, they captured 8% of US razor sales. Unilever bought them for $1 billion in 2016. The company that invented the razor and blade model was disrupted by a subscription service selling cheaper blades. Around the same time, beards came back. Millennials and Generation Z started growing facial hair. Stubble became stylish. The clean-shaven corporate look faded. Gillette's core customer, men who shaved daily, started shaving 3 times a week, or twice, or not at all. Purchase frequency collapsed. By 2019, consumers were exhausted with Gillette's pricing strategy. For decades, the playbook was innovation and premium prices. The Sensor in 1990, the Magic 3 in 1998, the Fusion in 2006 with 5 blades and $30 for refills. Each generation cost more than the last. A 4-pack of Gillette Fusion 5 Pro Glide cost $28. A 4-pack of Dollar Shave Club's Executive Blade cost $9. The value gap became indefensible. July 2019, 14 years after the acquisition, P&G drops a bomb in its fourth quarter earnings report. An $8 billion write-down on Gillette. $8 billion. The company blamed currency fluctuations and market contraction in blades and razors, primarily in developed markets. Translation: people were buying fewer razors, and Gillette's pricing power was gone. Gillette still held 52.8% of the US market, dominant, but that was down from over 70% a decade earlier. P&G tried everything. Gillette branded subscriptions, price cuts. A controversial 2019 ad about toxic masculinity generated 160 million views in a social media firestorm. Nothing worked. March 2020, COVID-19 hit. Offices closed. Millions of white-collar workers started working from home. Video calls replaced in-person meetings. Men stopped shaving as often. If you are not going into an office, why shave every day? Razor sales cratered. E-commerce exploded during the pandemic. Consumers discovered cheaper alternatives online. Gillette's traditional retail dominance, prime shelf space at Walmart, CVS, Walgreens, mattered less when people bought razors on Amazon. Offices reopened, but hybrid work became permanent. The 5 days a week clean-shaven office worker, Gillette's ideal customer for 120 years, was disappearing. In December 2023, P&G announced another impairment. They recorded $1.3 billion before tax and $1 billion after tax. The company blamed a higher discount rate and weakening currencies. But the real story was in the fine print. P&G was using lower residual growth rates for Gillette. They did not expect the business to grow the way they thought it would. The announcement was buried in a broader restructuring plan. P&G said it was pulling out of Argentina and Nigeria because of challenging macroeconomic conditions. The Gillette charge barely made headlines. P&G paid $57 billion for Gillette in 2005. By 2024, they had written off over $9 billion, more than 15% of the purchase price. In the 2023 filing, P&G warned that future adverse changes could trigger a further impairment charge. There could be more write-downs coming. Meanwhile, P&G's other businesses were cracking. China, P&G's second-largest market, was in freefall. In the first quarter of fiscal 2025, organic sales in Greater China dropped 15%. The chief financial officer said it would likely be a few more quarters until we return to growth in China. The beauty division dropped 20% because of weak demand for SK-II, P&G's premium skincare brand. Baby care declined as global birth rates collapsed. Even in North America, volume growth slowed as consumers traded down to cheaper private label brands. P&G's stock dropped 7% over 6 months. The company missed sales estimates in back-to-back quarters in 2024. Analysts downgraded the stock. The business model that worked for 180 years, based on premium brands, pricing power, and repeat purchases, was breaking in real time. Warren Buffett built his fortune investing in businesses with unbreakable competitive advantages. Gillette was the textbook example. It had brand loyalty, distribution dominance, patents on blade technology, and a business model that generated recurring revenue. Buffett owned Gillette from 1989 to 2005 and made a fortune. When P&G bought it, he called it a dream deal and made $645 million in a day. He could not predict that beards would become fashionable. He could not predict that a startup with a viral video would undercut Gillette's pricing. He could not predict that a global pandemic would normalize remote work and destroy daily shaving habits. P&G did not mismanage Gillette. They ran it exactly how you would expect a world-class consumer products company to run a premium brand. Consumer behavior just changed faster than anyone expected. Preferences shifted, technology enabled new competitors. A global event rewired how people work. In 2005, P&G paid $57 billion for what they thought was an unstoppable business. 20 years later, they have written off $9 billion and counting. Gillette still generates billions in revenue. It still dominates the category. But it is not the growth engine P&G paid for. It is a shrinking business in a shrinking market, managed by a company watching its other divisions crack under the same pressure, changing consumer behavior, emerging competition, and a world that moves faster than billion-dollar corporations can adapt. The Dream Deal became a case study in how even the smartest investors, the strongest brands, and the most dominant market positions cannot survive when the world changes underneath you.